Management feels, all right, so 26.4b, if you didn't hear that. Samba is a popular restaurant located in Brazelton Resort. Management feels that enlarging the facility to incorporate a large outdoor seating area will enable Samba to continue to attract existing customers as well as handle large banquet parties that now must be turned away. Two proposals are currently under consideration. Proposal A involves a temporary walled structure and umbrellas used for sun protection. Proposal B entails a more permanent structure with a full awning cover for use even in inclement weather. Although the useful life of each alternative is estimated to be 10 years, Proposal B results in a higher salvage value due to the awning protection. The accounting department of Brazelton Resort and the manager of Samba have assembled the following data regarding the two proposals. All right, so you got Proposal A, required investment of $300,000, estimated life of the fixtures 10 years, estimated salvage value $10,000, estimated annual net cash flow $75,000, depreciation straight line basis $29,000, and question mark on estimated annual net income. For Proposal B, required investment, a little bit more money, $310,000. Estimated life the same, 10 years. Estimated salvage value $40,000. Estimated annual cash flow $70,000, and depreciation here is $27,000. So it says, for each proposal, compute the payback period, the return on average investment, or accounting rate of return if you wish, and net present value discounted at management's required rate of return of 10%. Round the payback period to the nearest tenth of a year and return on investment to the nearest tenth of a percent. Use exhibits 26-3 and 26-4 where necessary. That's for the net present value calculation. All right, so let's see, how do we do this? Let's put here at the top Proposal A, and over here Proposal B. Okay? And so the first thing we want to do is payback period. Oops. And for A, Proposal A, it is simply $300,000 divided into the estimated annual net cash flow of $75,000. So this is a real easy 4.0 years. Okay. Now for Proposal B, it is $310,000, and into that we're going to divide the $70,000 estimated annual net cash flow So here, the payback period for proposal B is a little bit longer at 4.4 years. So I mean, if you were doing strictly the quick and dirty payback period estimation, which would you pick? Well, from this analysis, you would pick proposal A, and again, you'd have to consider all the downside, all the negatives to payback period. Doesn't consider net present value, doesn't consider cash flows after the payback period, all that stuff. All right. Second thing we want to do is the return on average investment. So for A, here what we're going to do is we're going to let's see. Let's go back here. So our calculation is average estimated net income. That's our numerator in this, and our denominator is average investment. And for A, average estimated net income is your net cash flow minus depreciation. Okay, and over here, your denominator, your average investment, is the original cost plus salvage value, and you divide that into 2. So let's clean this up. Your numerator is going to be what? 75,000 minus 29,000. So that's 46,000. So I'm going to put that down here. And then original cost, let's put that right here. Original cost of this is 300,000. And you're going to add back in depreciation, and you're going to divide that by 2. And so 310 into 2 is 155,000. Okay. So here's your average net income, average estimated net income, 46,000. You figure that out by taking your net cash flow and subtracting depreciation. Excuse me. And then your average investment is your original cost plus salvage value, and you simply divide that into 2. And here 310 divided into 2 is 155,000. So this is going to be 0.297, or if you want, 29.7%. Now over here, we simply take 70,000 and subtract 27,000 for our average estimated net income. So what is that? That's going to be 33,000. Excuse me, 43,000. So I'll put that down here. And your denominator is going to be 310,000 plus your salvage value of 40,000. You're going to add that back in. So that's 350, and you're going to divide 350 into 2, which is going to equal 175,000. And so that equals 0.246, or 24.6%. Okay? So hopefully you caught that. Hope the paper didn't go too far to the left during that whole thing. But anyway, next. All right, so for net present value, let's move this up. What you're going to do is you're going to use your present value tables here in Exhibit 26-3 and 26-4, and the net present value is discounted at 10%, meaning they require a 10% return at least on this, whichever investment they're going to consider. Not only that, but they're going to pick the proposal A or B with the higher net present value, assuming that their resources are limited, which they are. I mean, they can't pick both option A and option B, right? because we're talking about the same space. So it's got to be either A or B, and if that's the case, they want to pick the higher net present value of the two. But at the very least, before either project's acceptable, it's got to have at least a 10% return on it to accept either. All right, so back to this. So net present value discounted at 10% for proposal A, and so first we're going to take our total, we're going to have to figure out our total present value at 10% annual net cash flows. And that number is the following. So we'll put a little parenthesis down here. It's the $75,000 that they expect in annual cash flows, estimated annual net cash flow in the problem says proposal A, estimated annual net cash flow is $75,000, and we're going to multiply that times 6.145. Okay? Now, where did that number come from? Well, if you look at your table, Exhibit 26.4, you go to the discount rate of 10%, and you go down to year 10. This is a 10-year life. You come up with, at the intersection of 10 periods and 10%, you come up with a figure of 6.145. Now, how does that correspond with the Exhibit 26-3, the table above it? Well, if you were to take the sum of all of those under 10% for year 1 through 10, 90.9, 0.909, 0.826, 0.751, etc., all the way through year 10, 0.386, those numbers would add up to 6.145. Okay, so that's where that number comes from. This 26.3 exhibit will come into effect when we do our calculation for the present value of salvage. All right, so 75,000 times 6.145 equals 460,875. Okay? Now I'll probably have to do B on a separate sheet of paper because I don't want the paper to get all jumbled up. To that, we're going to add our, so total present value at 10% annual net cash flows, that's this figure. And to that, we want to add our present value of the salvage value And that's at the end of the 10 years. And so that figure is what? Well, says that the salvage value for A is estimated to be $10,000. So you're going to take 10,000, the salvage value, and multiply it by the number in year 10. Here you're not going to add them up. You're just going to take the number in year 10 under the discount rate of 10% that is shown in Exhibit 26-3, and that number is 0.386. So 0.386, so that's going to be $3,860 that you're going to add to this $460,875, and so that equals our total present value of $464,735. Okay? And what we subtract from that is the amount of our investment, which in this case is $300,000. And so we have a positive net present value of proposal A of $164,735. Okay? Now, let me get a new sheet of paper and let's do proposal B. Same deal. So 3 continued. Proposal B, this will give us more room to work. Same deal. Total present value of 10 annual net cash flows is going to be 70,000 in this case, times the same number, 6.145. Nothing's changed there. Proposal B is also a 10-year project, and the minimum annual rate of return has to be 10%, so still going to be 6.145 for this one. And so that number is $430,150. Okay? And to that, you're going to add your present value of salvage value in year 10 and that number is the 40,000 estimated salvage value times same number as above in proposal A, 0.386, because it's still being sold in year 10. So 40,000 times 0.386 is 15,440. Okay, so you add those two numbers up and you come up with 445,590. And that is your total present value. Okay, and again, you're going to subtract your amount of investment. I forgot to write that on proposal A, but that's what this is, the amount of the initial investment, which in this case is 310,000. Okay? And so here, the net present value equals 135,590. Okay, so again, if you compare the two, okay, bring it down a little bit. Forgot to do the amount of investment, so make sure you identify that in proposal A. Proposal A net present value is $164,735. Proposal B is $135,590. So all other things being equal, you would choose proposal A over proposal B because it has a higher net present value. So again, the total present value less amount of the investment is your net present value. In all instances, must one of these be positive numbers. If these one or both of these were negative numbers, you wouldn't even consider them. But because they're positive numbers, you have to consider both of them. And of course, the higher of the two is the one you're going to accept. Okay? So that's your assignment, calculating payback period, accounting rate of return or return on average investment, and net present value. Pretty straightforward. So anyway, your last assignment, you should have fun with this.